Welcome to the network that powers the world's alternative investment marketplace. Welcome to iCapital Network.
Thanks for joining us, guys. What a great week to be talking about asset allocation as the market freaks out and about China and other issues. I mean, it's at these moments that discipline comes through. So Michelle, I'd like to start with you. When we last spoke, you said to me the 70-30 portfolio is dead. What do you mean that the kind of traditional portfolio is dead? What did you mean by that, and what's alive, as it were?
Sure, and I think Ray put a nail in it, and Noriel hammered it home too. But the major point, Russell advises to some of the most sophisticated asset owners around the world. We advise to 2.8 trillion and then manage another 330 billion. And those plans are, and we also work with advisors, but those major plans have always focused on liability matching, right? And so they've been very sophisticated in terms of asset allocation, risk allocation. They have access to the world's best managers. We have access to the world's best managers. But ultimately, that 60-40, 70-30 mix, however you want to think about it, has been turned on its head over the course of the last decade, is actually how long it's been going on. It just has been adopted more holistically, first by endowments and foundations and high net worth individuals. And now, hopefully, as your panel discussed before, we can democratize it even more with middle market institutional plans and DC and DB plans, but also with the wealth advisors eventually. And what that means is that instead of using cash and fixed income and equities and thinking about it as public securities, and then you very almost rotely think about attaching alternatives as an addendum, it's really turned itself upside down so that you really do think about risk allocation at the individual security level. So that if you can get transparency, you can get data, which is what we have been doing, especially with our partnership with Hamilton Lane, making sure that we give that level of transparency that you can manage risk at the holistic total portfolio level and think about not just tools for access or technology for access, but think about how you truly risk allocate at individual security levels. Then all of this that we've been talking about really turns itself on the head, which is why 70-30 should be dead, 60-40 should be dead, and we really ought to be much more integrated and holistic as we think about combining the factors and attributes of private securities with our public security listed capabilities.
I guess the one risk that we're thinking a lot more about in the last couple of months in terms of portfolio construction is inflation. I wanted to ask you about that, Anastasia. You specialize in alternative assets, alternative allocations. Does the inflation picture change how your clients are building portfolios, what you're recommending? Are we living in a new world already, or are we waiting to see if the new world is going to arrive?
Well, it definitely does change how clients should be thinking about portfolios. It should change how clients are thinking about portfolios. And Rob, I think you and I agreed in our prep call that this has been the question of the year. Is inflation transitory? And I was like, do we really still want to talk about this? But you told me this is still the key debate.
Yeah.
If
it's not, what do you do, right? The problem is, I get 3.5% inflation, and my bonds aren't a hedge anymore.
Well, that's
and
right.
Now I don't know what to do all day long.
That's right. So I think we have to unpack this the comment of what is transitory, what is not. First of all, I do think that part of inflation picture here is transitory. We're not going to see 4 or 5% prints for the next 18 months, but are we going to see above 2%? Are we going to see above 2.5% and above 3% for the next 12 to 18 months? And I think the answer is yes. So let me kind of back that up why I say that. The part of inflation that is transitory is the used car prices and the semiconductor prices, and have you tried to buy furnishing lately? That part is transitory, and we have already seen that start to come down in the last couple of inflation prints. So the Fed is pretty happy about this because that part of the transitory narrative is actually starting to play out. I think we've seen the lowest month-over-month increase in inflation since February, just for this last month. So that's good. But
are house prices in Greenwich included in that basket of goods? Or
yeah, well, you guys live here. You tell me about this. But like I think even housing inflation, residential housing inflation probably will start to decelerate on the margin. But Rob, the point I really want to make is that about 1.5% of current inflation comes from these transitory factors that will subside. But we're at 3.5%, right? That doesn't mean we go below 2%. It means we'll likely stay around 2% for the foreseeable future. So that part is not transitory. And back to your point about bonds, is we're still living in an environment where you'll have 2% inflation. You'll probably have some more upside to bond yields, either because the economy accelerates or we're going to print a lot of money and we're going to borrow quite a bit. So this is a risk that is definitely worth hedging in our view. There's ways to do that. Private credit, real estate is something that Michelle is agreeing with me. Thank you. It's something that we should be incorporating.
I definitely want to talk about both real estate and private credit. They're hot topics. But before, I want to add one more kind of conceptual item to the mix, which is valuations. I did an interview a month or two ago with Howard Marks of Oaktree. I don't know if Howard's here, but he basically said, I said, valuations of everything look high. What do we do now? And he said, you suffer, right? It's a low return world. It's a hard world to make money in. And I'm wondering with you, Eric, is that true everywhere? Or as you look across a truly diversified portfolio with alternatives, do you think valuations are universally unappealing, or are there islands of sanity out there?
I think things are definitionally expensive when real interest rates are this negative.
Yes.
It pushes money into literally anything. So, and I think we're seeing that. And so, valuation is a relative concept. So, when I don't invest in individual equities, it's not that I've viewed it as a scam. It's just, I think there's just a lot of there's a lot of kind of pump and dump activity in individual equities. And the reality is, when I've always looked at equities and I look at equity analysts, I think the PE multiple is so much more important than all the things that they focus on. So, they're focused on earnings, they're focused on margins, they're focused on all these things. And I don't doubt that those are important, but they seem over the long haul, they seem trumped by what the PE is. And so I think the question for all of us right now is, in this world where 10-year rates are 130 and inflation is, make up the number, 2.5, 3.5, 5. What's the right PE for equities, or how would you look at that in terms of real estate? I don't know what the answer is. I think the answer could be that it should be extremely high and will likely be very volatile. And so that's roughly where I come out. I know that's a pretty unsatisfying answer, but I see the conditions in place potentially. Like, I assign a 25% probability to we're on the cusp of some asset price boom that is truly historic by all human history standards. Because when I'm a student of economic and market history, I haven't seen this set of conditions ever, where the world is deeply in debt, but that debt has now been priced because of central bank activity, low inflation, activity. It's been this huge pool of assets has been priced to guarantee losses that are utterly staggering. And the policymakers are pressing for that paradigm to remain in place.
At negative rates, any PE makes sense.
Technically, I'm not that smart, but it seems like
on real estate,
It's about relative opportunity, right? And when you do have the unprecedented amount of liquidity, I mean, I think the last numbers are for the U.S., it's 45% of GDP that's been pumped into the system with $10 trillion, and it's 30 trillion and 37% of global GDP. And so back to the point, when 30% of sovereign debt is negative, I think all of us that have been around for a while, you've got to rebase yourself and do the math and just forget the old rules of thumb, because it is about relative opportunity. So whether that means, early stage private equity, or it's small mid-cap private companies, private credit, again, it's relative to what? A guaranteed negative return, or what's less evil, all things being equal. And someone said something about I think it was iCap CEO said something about just making sure that the regulators don't lose sight that individuals do have funding needs. There are real liabilities that people are trying to meet, whether it's retirement or whatever else. And with the clock ticking on that $400 trillion number that the World Economic Forum talks about as being the retirement gap, you do have to proactively invest your assets. And so in a world where we do have to make up for inflation as well as produce positive real returns, you need to have the whole world as your oyster. And I think that's what you're hearing from all of us.
Anastasia, is that what private credit does for you? You get a real yield.
Well, you do, which is not much of it out there. But I think private credit is a very important topic of conversation right now. And I'm going to bring it back a little bit to the Fed discussion that is ongoing right now, and kind of bring it back to what's happening in Washington. I think one of the risks that we're all pointing out right now is the biggest risk to valuations if you have a rise in interest rates. Everything is fine for now, as Michelle pointed out. If you have earnings yield on the S&P, which is much higher than the 10-year Treasury, that supports a lot of valuations. But to the extent that that starts to change, we need to think about what kind of assets do we need to have in the portfolio. So Rob, one of the risks right now, what if we do pass the $3.5 trillion reconciliation package? What if we do pass the infrastructure stimulus? How much extra borrowing is that going to mean for the economy? Well, I'll tell you, the CBO right now says that on average, $400 billion extra will be spent every single year in budget deficits, meaning that needs to be financed in the Treasury market. So could that raise interest rates? I think so, at least the 10-year nominal yields. Now, on top of that, this is actually extra stimulus that could be getting to the economy, which doesn't necessarily need stimulus to stimulate demand. We don't have a demand problem, we have a supply problem. So might the Fed want to start to respond to that? This is my long-winded way of getting to private credit. I'll get there. The Fed may start to want to respond to an economy that is increasingly in a good position, and inflation may actually be continuing to overshoot to the upside. The markets are not ready for this. If you look at market pricing, market participants will tell you they expect the first rate hike sometime in 2023. The market pricing will tell you that it's sometime in late 2022. You know how many rate hikes they actually expect at that point? One. They're like the end of...
We're at 25 basis points.
That's right. So it's nothing. So I think one of the bigger risks today is this upside risk to rates that the markets are not prepared for. So why do I come back to private credit? Well, private credit, as we started off this morning, is a $1 trillion asset class, most of which is priced at LIBOR plus a spread. So you're talking about floating rate securities that would not have the same duration hit that a lot of the other government bond market would. And by the way, they do offer a spread of 500 to 800 basis points over LIBOR. Tell me you can find that in high yield or love loans.
And a lot of that too, if you focus on asset back instead of a credit spread, that's where private credit gives you the opportunity more so than you get in the public markets. And combining them within portfolios really gives you the lever to change your credit spreads however it is you might want to, while you still get that added premium.
What default rate is priced into those 500 basis points over LIBOR?
Well, we should have a conversation about the default rates, and I knew you were going to.
We don't have defaults. The government has eliminated defaults. It's a thing of the past. It's an ancient technology we don't use anymore. The default.
I hope it doesn't come back for a while. But I will say that if you look at the performance of private credit, it tends to outperform when you have a strong economic environment. So when you look at times when ISM manufacturing was above 50 in expansion territory, private credit tends to outperform. My expectation is we're going to be there for the next year, maybe year and a half, maybe 2 years. And so that is supportive of low defaults, and that is supportive of that environment. The defaults that we're looking for are probably sub 1% in the next 12 to 18 months. And that's, I wouldn't say that's exactly what's priced in, but that's what we would expect.
Let me put a little pitch in for Eric's paper, The Case for Quantum Change, which everybody should have a look at. You mentioned volatility, and one of the things you say in your paper is that we're heading into a more volatile environment. So we've talked about inflation, we've talked about valuation, now let's add a third element, which is volatility. Why do you think volatility is going up, and how does that change asset allocation?
There are a whole, kind of a whole host of reasons that vol should and I think will go higher. We've seen glimpses of it, right? We certainly saw in early 2020 a lot of volatility. And what I've observed is that each time we get through these crises, people think, well, all right, well then that's the next one is never going to be as volatile as the one before. I think it's likely that the next big event is more volatile than the last one, and more volatile than 2008 actually. And it'll probably be catalyzed by this moment where inflation expectations where central bank policy is supportive of asset prices because it's too concerned at such low rates about creating a poor economy.
Yeah.
And so it is definitionally behind the curve and then actually goes to start tightening policy. That impacts asset markets, and then the Fed panics and says, oh no, we need to stop hiking rates. And that will be I think that's the greatest moment of risk for markets looking out over the next, let's say, 3 to 5 years. So
they start to tighten, markets throw their toys out of the pram, and you get the Fed backing off and losing credibility. Is that what happens at that point?
Correct.
Yeah.
So when you look at the big crises over time, they're really the biggest ones are when central banks lose credibility, and so we haven't, and when frameworks, kind of market frameworks, lose credibility, things that people have assumed are given just fall by the wayside. So a good example of that would have been ERM in the early 90s. When that was a framework that everyone believed in, the central banks were in control, and then we discovered that they weren't. And so you saw pretty catastrophic volatility for some markets. So we haven't seen that in the US, and we may not, by the way. When I point out a risk for major volatility, that's the major risk. I don't think that's 3 months, but I think that the more enduring cause for more volatility is that over the course of my career, which started in the late 80s, we've been in this paradigm of central bank dominance where there's been very little fiscal volatility, really. And economic policy has been dominated by what central banks do. They've bailed out the economy at every recession. They've moved to lower and lower rates, more leverage in the economy, et cetera. What we just observed is the period where central bankers got to more or less the end of the rope. And so the last, preceding March 2020, central bankers were crying out for fiscal support, but there was no political will to actually join central bankers and provide a fiscal impulse, right?
Yeah.
And so what the catalyst that we just observed, what it did is it gave parties across the political spectrum the imperative to really go out and borrow enormous amounts of money. And now that that's happened, it's re-engaged politicians. So monetary policy at the zero lower bound with 10-year rates at 130 basis points deeply negative, there's really not very much they can do other than more QE. And that lifts asset prices, which amplifies some of the problems that we have right now. So the solution really is a fiscal solution. And central bankers don't spend money, politicians do. And so you observe between countries, they have very different views around how they borrow money, what they spend it on. Even within a country, a Trump America is different from a Biden America, both in terms of how you borrow and do you do tax cuts? Do you spend on clean tech? Or do you give people money? What do you do? And so what we've just observed is this, I call it a quantum change, this phase change in policy where we've gone from policy homogeneity, which was global central banks were all really working off the same playbook, which was the Fed playbook, which that's what happens when you have a dominant reserve currency. Everyone has to adopt the dominant reserve currency central bank policy. And we've now transitioned into this world where politicians are going to be the ones that are really going to introduce new policy vol into markets. And so I think that's something that's enduring, that'll be a 20 or 30 year.
But it's Michelle's job and it's Anastasia's job to build portfolios that are ready for a volatile new world.
Mm-hmm.
So what are the kind of portfolio management implications of the new regime that you're talking about? What does a well-hedged portfolio look like in the new regime?
Well, I was going to say, if he's right, we're going to be really busy.
Yeah.
Yeah. So where do you start with that? Yeah.
Well, here's what I would say. So our business, we create portfolio solutions with a number of different funds that we run. We have never seen the level of inquiry that we're seeing, which I would have expected because of this transition. And effectively, what's happening is the most proactive investors are coming to terms with what Michelle and Anastasia are talking about, which is the 60-40, 70-30 portfolio is broken. And so the question is, how do you replace your bonds? Mm-hmm. And so the truth, the unfortunate truth is the the portfolio construct that has worked so great for the last 30 years is huge and scalable. It's wonderful. That's why there's so many bonds in the world. There's been so much appetite for that because all these things work in tandem. Equities and bonds work great together. If the bond part of your portfolio no longer works, there isn't anything that's as scalable as bonds that can replace them. There are more niche strategies that can replace them. And those things have to do, we happen to manage those types of strategies in anticipation of this change that seemed inevitable. And so things that do work, trend following strategies historically work. By the way, they just had their worst decade of the last 10 years. And I think what you should start seeing is you start seeing the things that haven't worked well. If you believe in a policy paradigm shift, things that didn't work great should start working well. Yeah. Things that worked best should start working less well. And I think as you look at different strategies throughout the industry, you're starting to see that, or you have seen that actually over the last couple of years, right?
I was going to say, what else works well, which there's been a lot of debate around, is growth. That's been a big debate in the markets this year. Is it growth versus value? Do you reposition your portfolio? And, near term, yes, I think there's some upside to value. There's upside to pro-cyclical stocks. I would buy the reopening trade. I would buy energy. But longer term, we need to step back and say, does growth actually really ever go out of style? And I don't think growth ever goes out of style. So as you think about your 60% of the portfolio, what should that growth be? Should it be public equities? Should it be private equities? And what I would say is the way I think about growth and investing is if you could really only invest in one thing and not care about the risk, which of course you do, but you would invest in innovation. You would invest in disruptive technologies. You would invest in mega trends that change and shape and disrupt the world as we know it. You would probably invest in digital transformation and all that goes along with it, fintech, AI, machine learning. You would probably invest in what the previous panel was talking about, gene therapy, precision medicine, liquid biopsy, and you would probably invest in sustainability. How can we be the most efficient with the use of our natural resources while mitigating the damage to the environment? That's sustainability, that's impact. So that's what you would do. Now, the question that I often get from clients when I talk about investing in these mega trends is, well, how do you do it? Do you invest in public markets? Do you invest in private markets? And the answer is you do both. There's definitely areas that you can find in the public markets that maybe the companies start as small caps, they grow up to be mid caps and eventually large caps, and there's a lot of value creation that can be captured. But you know what else? You can really capture that value is if you invest pre the IPO, if you invest in these companies that are experiencing this hyper growth, they're growing 70-80% per year in terms of revenues. You can't really find that in the public markets. So
there is tremendous demand on the company side for private capital. In other words, the companies want to be private for longer.
Yeah,
they do, but not this year.
The one amazing stat, which blends into what you're both saying, but the one amazing stat is there are 2,600 companies that are over $100 million that are public, and there are 17,000 companies that are private that are over $100 million. So if you limit yourself to the public markets, you are limiting yourself to 15% of the investable companies.
That's right.
And this is the critical. I mean, we all talk about the last 20 years. The number of public companies have gone, I think, from 7,600 to 4,600 or something like that.
Lower, I think.
But look at it from the other side of the equation. You would never limit yourself to 15% of the investable universe. And so just the world really is your oyster.
Yes.
Eric is right that it's not as scalable as purchasing muni bonds or fixed income, but you have infrastructure, you have real estate, you have VC, you have private companies that are exploding in terms of opportunity set. And the better we get as an industry of providing access, but in a responsible manner, so we can control and have transparency to the risk. So we monitor those things as well as we've always historically monitored public. Then I think you get much better portfolios to live through the scenarios that Noriel and Eric are posturing for us. But that's critically important because they work hand in glove with each other.
So that's our 60%. It has to be more private assets.
Yes.
Your equity has to be more private
They
assets,
have to
just
be
because
core.
that's the universe of assets that are out there.
Yeah,
right?
we would argue that they're core to a portfolio.
Okay.
There not alternative.
Let's go
any
back to
longer.
the
Yep.
30 or the 40%. Let's say the bond part of the portfolio is broken. What slots? How can you move away from classic fixed income? What else goes in that part of the allotment? We've talked a little bit about private credit. What else can go in there?
Yeah, I certainly would argue real estate, real
Yes.
assets, infrastructure. There are a lot of other things, private credit and all of its shapes and forms. And don't forget, we were talking about derivatives being taxed. I hadn't heard that one yet. I probably should have. But you can also do derivative overlays to ensure that you're getting factor exposures, balancing risk, and not disrupting the private investments that you're making in the illiquid part of the portfolio. So there are all kinds of ways that these various asset classes can work together, get you exposures that are more risk appropriate, and work around the liquidity drawbacks, but they also give you the premium within the private markets. But what else would you?
Yeah, I mean, I absolutely agree with you on all of that, but especially real estate, I think is an incredibly interesting and timely opportunity as we speak right now. First of all, this is a $16 trillion market, right? And there's a lot to do across residential, commercial, office and hospitality. And the reason I say it is so timely today is because clearly a lot of real estate has been left behind during the pandemic and a lot of it is still not recovered. So I'm always looking for what is the catch-up trade, what is the contrarian trade that's going to position me well for the next few years. And to me, real estate very much stands out there. Going back to the inflation debate, you could hedge that with private credit, but you could also hedge that with real estate. If you look at multifamily housing, for example, Greenwich houses aside, if you look at, multifamily in New York, those incentives are gone, those concessions are gone, and you started to see rent growth returning to the market once again. You've seen that in multifamily. You're definitely not seeing that in office. You probably won't see that for the next few years. You're starting to see a little bit better NOI growth numbers in definitely in hospitality. So a lot of the real estate growth is coming back, and that's your inflation pass through. And pricing is stabilizing. People are back out traveling. The hotel occupancy, here we are, is back to 70% levels out there. So all of this is actually incredibly supportive of the market. So I like the longer term opportunity in real estate. But I think it's also very timely from a market perspective.
I'm taking the other side of office real estate, though. We can have a
wait,
that stuff. Those REITs are overpriced. I'm just putting that out there. That's the Armstrong trade of the day. It's short office.
That's just the one thing that I would just add. I agree wholeheartedly when it comes to the comments that you guys have made about being long innovation. I do. And I should certainly not be painted as a real bear. I think that economies and markets go through cycles. We're going to have, we have had them, we continue to have them, and as investors, you just have to be kind of clear-eyed about where you are in various cycles, right? And the challenge with this one is that I think inflation is coming because it's a policy choice.
Agreed.
I think it's a very rational one, so I don't think we should be upset about it. I think if you have economies that are deeply indebted and they're not functioning well, and there are a whole bunch of priorities that need to be addressed, be they social in nature and inequality or climate, money needs to be spent, and yet we're already deeply in debt. So what do you have to do? You can either have huge defaults and start all over, which there's no appetite for, or you can run a policy of inflating, of effectively debasing the value of those debts, and you do that through debasing currency, or if others are trying to debase it, you kind of everyone debases together versus hard assets.
Redistribution from debtors to creditors, or I'm sorry, from creditors to debtors.
Right. So there's certain things that you can do in that environment. One of the things that people tend to do is they tend to look at the 1970s, and there is a possibility that because rates have stayed so low for so long, that real estate is already, I'm not saying real estate wouldn't go higher in a scenario where there's monetary debasement, but it's very possible and probably likely that the starting valuations are already very high for real estate, so that you can't map your portfolio back and look at oil, for instance, in the 70s and say, well, that was great, or even look at gold, because gold wasn't free floating before the 70s, so it's probably the case that it's not a great hedge. I think when we try to solve these problems for clients, we think that inflation-focused bond strategies make sense. TIPS have been incredibly uninteresting for the last 25 years. Very few people know even how to trade them anymore. They just don't know how to allocate to an ETF.
Yes.
They're going to be great. There already are great opportunities there. Volatility markets they will have a resurgence. Again, that's a strategy that's had a terrible decade by policy design, and so this should shift. I already mentioned trend.
Buying vol has had a terrible decade.
Yeah. And by the way, you shouldn't always be long vol, but there are ways to be long vol and certain places to be long vol that pair well, that you can do in a much more concentrated way with your portfolio, so you don't have to have 30% of your portfolio like you did in bonds. Bonds have no convexity left. So the question is, how do you replace the convexity the bonds had with something else? And so trend helps.
Good way of putting
trend helps. Yep. Long vol helps in concentrated allocations, which you can get.
Right.
Inflation-focused strategies. By the way, digital assets, which we've made a big push into that. Digital assets, they combine some of the great qualities of innovation and venture with unique underpriced assets. I know Nouriel would disagree with that, but I think they're deeply mispriced, many of them deeply mispriced assets relative to the world that we're going into, with a call on innovation. And so those are some of the, if you can't solve the problem in the way that everyone has solved it for the last 30 years, definitionally you have to look at different things, right? And so those things that I just laid out, I think in various combinations, depending on risk appetites, they can replace the convexity of bonds.
Before we go back to crypto, and I want to hear from Michelle and Anastasia about tips in the modern portfolio. Do you guys, are you in favor, or?
Well, we haven't forgotten about them. We do use them as appropriate within client portfolios, and I would just emphasize that I think what you're hearing from all of us is the key. My key word would be diversification.
Yeah.
So there's a difference between strategic asset allocation, critically important. It is the core of what you're working toward, and the client touchstone, versus dynamic allocation and overlays within more volatile markets, and especially around thematic risks or macro or geopolitical or macro risks. And so all of those things should be thought about when you're trying to target either a liability need or a vol need or an income need. And I think what we would just argue for is be open to everything. Don't cut off any segments of the market, and then just make sure that the industry and the clients are working through the risk allocated in a highly tuned manner versus just doing the blunt tool of a risk premium for privates. It's just that doesn't exist anymore when you're talking about 17,000 individual options. You know, you can't, that's just not as fine of a tool as what we need to all start employing in order to get these allocations more right for clients. But tips absolutely would be a part of it.
Yeah, I think you're right. We should not rule out any of these assets out of the portfolio, and to the extent that inflation does surprise to the upside, I think that is a tool that you need to have in the portfolio. I want to go back real quick to the real estate discussion that we had. By the way, Rob, I'm with you that office real estate is probably not the best place to be from a price appreciation perspective over the next few years, but eventually that too will turn around.
Get
but
priced
I agree.
in at some point.
Yeah, but I agree with her, not quite there yet. And I also do agree, Eric, with your point that you're probably not going to see the most price appreciation from real estate because, frankly, we have not had, except for office, we've not had a tremendous amount of distress in real estate. It bounced back very quickly. Even for apartments, for example, you were still collecting rents. The rent collections were in the 90s, mid-90s percentages. So that didn't lead to the severe drops in value. And then to the extent that rates go up, you might have a negative valuation impact there. But the reason I go back to real estate is because where can I find an asset whose cash flow is tied in some way or another to inflation? And the answer is real estate. Going back to multifamily apartments, this is a very quick inflation pass-through that happens in some cases every month. Or if you look at longer term leases and they have the inflation price escalators embedded in them. The number that might surprise you,
even if you're not getting capital appreciation, you're getting a hedge,
That's
and you're,
right.
and you're getting something that's not necessarily correlated
right.
to the rest of the portfolio.
But the number that might surprise you, Rob, is the overall real estate net operating income growth is projected to be 2%. It'll, in line with inflation. But if you look to the right of that, leisure and hospitality, 8%. NOI market rent growth, and of course that's opportunistic. It's more risky, but you get my point. Between multifamily and hospitality, I think there's some upside to market rents.
Eric, did I hear you say that Bitcoin is mispriced at $42,000 down there?
Are you buying the hat?
No, look,
it's a serious question.
Look, we're people. I love how dismissive most people are over what's happening in this space. We're deeply engaged with it. We brought on the former SEC chairman, Jay Clayton, as the lead of our advisory council. We just completed an investment round where Goldman Sachs and Coinbase invested in that part of our business. It just was released today. Super exciting. These things are happening because incumbents recognize the power of these technologies to transform financial infrastructure in the world. And
so for you, it's a technology investment.
Yeah, I think Bitcoin.
Is that the right way to think of it, or is it?
It is both.
What's the source of value? What's the source of value?
It is both, which is what makes it incredibly interesting to me. So the way who was the Jim O'Neill was Goldman's economist years ago, right? I don't know what he's doing now, but I remember he went around the world and pitched the BRICS investment philosophy or construct or whatever it was, right? And he went around and did it, and I think some portion of people probably thought he was crazy and didn't do anything, and some people thought it made a lot of sense. And you know what they did? They picked up the phone and they told their brokers to go and buy a portfolio of these different, Brazil, Russia, India, China, et cetera. Guess what happens now? We are inundated with calls from institutions that feel like they need to learn more because these technologies could affect their businesses. None of institutions don't have their investment policy statement set up to be able to do this. It's not part of their asset allocation. So everyone's deeply interested. They have this growing sense of unease that the world is changing. They're not invested in a world where we have more and more fiat, right? And we're talking about higher and higher valuations in all these other assets, and yet institutions have literally not engaged in this space yet. So it's not just the technology underpins it, but the assets attached to that technology, at least for the next 5 years, you should view them as, we view them, I should say, as equities attached to a new type of company, which is a protocol. Okay, so you have this whole class of equities, which we misname in a way digital currencies. This whole class of equities that are going to change the way the financial infrastructure of the world operates in ways that are deeply unsettling to all the incumbents, and people don't own them yet. So I do think that they're deeply undervalued. It doesn't mean that you can put together a cash flow like a New York City apartment building. It's different. But again, we're talking right now about you have to think differently given that the world is in the process of this transition. And so I don't think you should have all of your money in these things, but you should absolutely have an allocation to them.
And I do think it's easy to dismiss it with Bitcoin or whatever else. It really removes the seriousness with which the disruption is taking place, especially for financial services companies and the underlying technology. And investors, real investors, are coming. But it's early stages, and it's gotten it's Saturday Night Live skits and the rest. I mean, so it's easy to dismiss it, but that's not what it is.
That leaves
That's
you with
not
the
what
last
it
word,
is.
Anastasia.
Thank you for that. I will say this has been a breakout year for crypto. And I don't mean just in terms of performance. You can look at the performance numbers, but it's been a breakout year in terms of adoption. I think Michelle is right that we've gone from the Saturday Night Live skits to actually institutional adoption. And we see it across the board. We see it in terms of companies that are adding crypto trading to their platforms. We see it in terms of assets under management that are being raised in crypto. We see it in small businesses and large businesses that start to accept crypto as payments. We see it as treasurers adding it to their to manage their own balance sheets. So we see more and more consumer, business, and institutional adoption. And to your point about how do you value this? There's a supply side, there's a demand side. To me, one of the most compelling things about Bitcoin in particular, what if this technology that provides payments that are cheaper, quicker, more private, more efficient, what if this disrupts a $200 trillion consumer payments market? Mm-hmm. And I bet you it will, a part of it. Because as that market goes more digital, I think Bitcoin has a role to play. What if Bitcoin disrupts the $600 billion global remittance market, where it takes 6.5% and 3 days to transfer something across borders? With Bitcoin, you do it in less than an hour at 1%. So I think the potential is there. If you look at the future numbers for future adoption of crypto, and if you gauge it as a network effect, which by the way is how we valued Google and Netflix and Facebook in the early days, that's where you get to some of the price targets that are much higher than where we are today.
Thanks, guys.
Thank you.
Thank you.
Thank you.
Thank you.